This accounting mini-lecture examines the adjusting entries related to accrued expenses. Accrued expenses are simply expenses that we have incurred but have not yet paid. One of the most common examples is accrued salaries or wages. Because most companies do not pay their employees on a daily basis, there will generally always be times for which an employee has worked but has not yet been paid. When we reach the end of an accounting period, we're required to account for those accrued salaries or wages. So let's walk through an example. Fast Forward's employee earns $70 per day and is paid every 2 weeks on Friday. The year ends on December 31st, which falls on a Wednesday. The last payday of 2013 is Friday, December 26th. From December 26th until year end is 3 working days. This means that the employee has earned $210 for Monday through Wednesday, but they are not going to be paid until the next payday in January. So therefore, we need to accrue the $210 for which we have incurred the expense and we owe the employee. To do that, we are going to debit salaries expense for $210 and credit salaries payable for $210. This records both the expense as well as our obligation to the employee. Okay, now let's look at the entry that's going to occur when we ultimately pay the employee in January. On January 9th, Fast Forward will pay the payroll for the 2 weeks from December 26th through January 9th. So this is what that journal entry would look like related to that specific employee. First, we are going to debit salaries payable for the $210. This basically removes our obligation to the employee for $210 because we're paying them now. We also need to record the other 7 days worth of salaries expense. Remember, we recorded the 3 days worth of expense in December. Now we need to record the other 7 days related to January. So we're going to debit salaries expense for $490. The entire $700 will be credited to cash as we're actually paying the employee. Another very common example is interest expense. So let's look at an example related to interest. Fast Forward borrowed $6,000 from First National Bank on December 1st. The note bears interest at an annual rate of 6%, and it's going to be repaid in 1 year. So we need to accrue 1 month's worth of interest, okay? And in this case, to compute the 1 month's worth of interest, they took the principal on the loan, which is the $6,000, times the annual rate of 6%, and they multiplied that by 30 days divided by 360 days in a year. And this will vary a little bit. Sometimes you'll see 360 days used. Sometimes it's 365. It's normally not going to make a significant difference. But this is the way that they made their calculation, was assuming 360 days. So this gave us an interest amount of $30 for 1 month. So we're going to debit interest expense for $30 and credit interest payable for $30. This records the expense, and it also notes our obligation to pay that $30 worth of interest. Thank you for watching this video on accrued expenses.